Hello everyone. Today we will talk about the topic of market cycles. What are they? Why do we need them? And how can we apply them in our trading? Let's go. I have prepared a small presentation for easier understanding of the topic. The presentation includes slides and a brief description of the topic. Market cycles. What are they? Market cycles are successive phases of price changes characteristic of each market, asset. Market cycles. What are they? There are 4 market cycles. The first is accumulation. The second is impulse movement. The third is distribution. And the fourth is corrective movement. What is accumulation? Accumulation is a phase of price consolidation during which smart money accumulates long or short positions. What is impulse? Impulse movement. Impulse movement is a period of rapid growth or decline in the value of an asset. What is distribution? Distribution is the stage of profit taking on previously open positions. What is corrective movement? Corrective movement is the stage preceding a new cycle of price change in the asset, opposite to the current trend. Market cycles. I show 4 possible states of price. These are consolidation, impulse movement, corrective movements, and also reversal. The use of institutional tools allows to determine the current and likely future price phase, enabling the trader to trade systematically and as effectively as possible. Confirmed. Next, the phases of market cycles. This slide is simpler for understanding market cycles, so let's take a look at it. What types of market cycles are there? There is distribution, corrective movement, accumulation, impulse movement, distribution, corrective movement, and then accumulation again, and then again impulse, and so on. Market cycle analysis technique. How can market cycles be simplified for market management? For simplicity of understanding, let's consider the time frames. There, market cycles can be reduced to 2 stages. This is the impulse movement, and this is the corrective movement. Let's take a look at the slide. Impulse movement, corrective, impulse, corrective, impulse, corrective, impulse, corrective, and so on. A higher time frame chart often does not display certain market phases that are clearly identified on a lower time frame chart. An upward trend is always formed through a sequence of previous market cycles. Market cycles can interact with each other, both on the same time frames and on different ones. This implies the presence of multiple cycles within a certain price range, directed either in the same direction or in different directions. Let's note that they have a hierarchy of importance. One cycle will always be leading. It plays a primary role, serving as a starting point for other, smaller cycles that form and exist within its framework, often during corrective phases. Next, we have the following slide. The diagram above, here it is, demonstrates this with several highlighted parameters. The first cycle. The bearish cycle is primary because it actually initiated the downward trend. Now the price is in a corrective state between previously formed extremes. And the second cycle. The second cycle, minor bullish cycles have emerged, forming a local upward trend. The rise will end when the price reaches key values for smart money, at which point their orders will be executed for further decline of the asset within the main cycle. The same logic applies to the third cycle, a bearish cycle that formed during the initial correction of the local upward trend. After reaching a significant support zone, the upward price formation continued and a new, bullish cycle began. Impulse and correction form a trend and always include phases of accumulation and distribution which is also applicable to the example being discussed, for instance, the third one, on a lower time interval. Next, cycles often repeat, with the price moving in one direction until it reaches certain institutional targets, after which a reversal phase begins, starting a new cycle in the opposite direction from the previous one. The time interval being considered affects the frequency of cycle changes. The lower it is, the more often this occurs. This is because price formation on lower time intervals depends on the trend at higher time intervals. When a correction occurs on a regular daily chart, the cycle changes from bullish to bearish on lower time intervals, or vice versa. Most importantly, the time interval being considered affects the frequency of cycle changes. The lower it is, the more often this occurs. Something like that. And so we have come to the end of a short lesson on market cycles. I hope you enjoyed it. Subscribe, like, all the best.